Hey there, fellow Americans. Welcome to another deep dive into the fascinating and often tumultuous world of California politics. Tonight, we're diving into the wild world of California politics, where the stakes are high and the debates are even higher. We're focusing on their ambitious plan to tax the super rich, a proposal that's shaking up the Golden State. It's like a real-life Monopoly game, but instead of boardwalk, we're talking about Silicon Valley mansions and sprawling estates. California's proposed wealth tax has sparked a whole lot of debate, with opinions flying from every corner of the state. Supporters say it's about time the ultra-wealthy pay their fair share, arguing that this tax could help bridge the growing economic divide. Opponents? Well, they're busy packing their bags, metaphorically or maybe even literally, fearing an exodus of the wealthy. So, buckle up as we unpack this controversial tax plan, examining its potential impacts on both the rich and the not-so-rich. We'll explore the concept of corporate greed, cue the evil laughter, and how it plays into this heated debate, and see if this whole thing is a recipe for economic disaster or a much-needed dose of fairness. Is it a bold move towards equality, or a risky gamble with the state's future? Let's get into it and find out together. Alright, picture this. A tax system where the more you have, the more you contribute. Sounds simple, right? That's the basic idea behind California's wealth tax. It's like a progressive income tax, but on steroids. Instead of just taxing your income, they're coming after your assets. Think stocks, bonds, real estate, that vintage Beanie Baby collection you're still holding on to. You get the picture. The goal? To address income inequality and generate a whole bunch of cash for state-funded programs. Think education, healthcare, maybe even fixing those pesky potholes. But is it really that easy? Let's find out. Now let's talk about corporate greed. It's a term thrown around a lot, often with a healthy dose of righteous anger. But what does it actually mean? In a nutshell, it's when companies prioritize profit over everything else. Their workers, the environment, you name it. Think megacorporations dodging taxes, exploiting loopholes, and paying their CEOs obscene salaries while their employees struggle to make ends meet. The wealth tax, some argue, is a way to hold these corporations accountable and redistribute some of that wealth. But is it the right way? Let's see what happens when people start jumping ship. Imagine this. You're a billionaire living the good life in California. Suddenly, a new wealth tax threatens to shrink your fortune. What do? Well, if you're Elon Musk, you pack your bags and head to Texas. That's where exit taxes come in. They're like a parting gift from the state you're leaving, a way to discourage wealthy individuals and businesses from taking their money and running. But here's the catch, do they actually work? Or do they just end up punishing those who can't afford to flee? It's a tricky balance. Section 5, running for the exits, real-world examples. California isn't the first place to grapple with the potential exodus of the wealthy. History is full of examples of similar policies and their, shall we say, mixed results. Remember France's wealth tax? It led to a mass exodus of millionaires, with many hightailing it to neighboring countries with more favorable tax structures. Was it a success? Well, that depends on who you ask. The point is, implementing a wealth tax without considering the potential consequences is like playing economic whack-a-mole. You might solve one problem but create a whole bunch of new ones in the process. Section 6, the Swedish Exodus, a cautionary tale. Let's hop across the pond to Sweden, a country often held up as a shining example of social democracy. They had a wealth tax once, but it didn't quite go as planned. Turns out even Swedes don't like paying exorbitant taxes. Many high earners fled the country, taking their wealth and expertise with them. The tax revenue dwindled and the government eventually scrapped the whole thing. The lesson? Implementing a wealth tax without addressing the concerns of those it affects can backfire spectacularly. Nobody likes feeling like a cash cow, not even the super rich. Section 7, France's wealth tax woes. Remember France, the land of baguettes, romance, and apparently tax headaches? They also had a go at a wealth tax, and it didn't exactly go swimmingly. The tax, introduced in the 1980s, aimed to redistribute wealth and fund social programs. Sounds familiar? However, it faced staunch opposition from the wealthy elite, who argued it stifled investment and discouraged entrepreneurship. Facing mounting pressure and a shrinking tax base, France eventually repealed the wealth tax in 2018. It's a cautionary tale about the challenges of implementing such policies without triggering unintended consequences. Section 8. The Balancing Act, Fairness versus Economic Stability. So where does this leave us? The debate over wealth taxes boils down to a fundamental question: how do we balance the need for fairness with the importance of economic stability? On the one hand, it's hard to argue against the idea of the wealthy contributing more, especially when income inequality is widening at an alarming rate. On the other hand, driving wealthy individuals and businesses away could have disastrous consequences for state economies. It's a tightrope walk, and there are no easy answers. It requires careful consideration, thoughtful debate, and maybe a whole lot of compromise. Section 9. Holding corporations accountable. Is this the way? Proponents of wealth taxes argue that they're not just about generating revenue. They believe these taxes serve a dual purpose. They're about holding corporations accountable for their actions, ensuring that they contribute fairly to society. By taxing their wealth, the thinking goes, we can incentivize them to behave more responsibly and ethically. The idea is that with a financial stake in the game, corporations will be more mindful of their impact on the environment, their employees, and the community at large. But is it really that simple? Can a tax truly change corporate behavior? Critics argue that wealth taxes are a blunt instrument that could stifle innovation and discourage investment. They worry that such taxes might drive businesses to relocate to more tax-friendly regions. They argue that there are more effective ways to hold corporations accountable, such as implementing stricter regulations and ensuring rigorous enforcement of existing laws. These critics believe that a well-regulated environment can achieve the same goals without the potential downsides of a wealth tax. Ultimately, the question is whether wealth taxes are the right tool for the job, or if they're more likely to cause more problems than they solve. The debate continues, with strong arguments on both sides. Proponents see it as a necessary step towards a fairer society, while opponents view it as a risky move that could harm economic growth. The answer may lie in finding a balanced approach that addresses the concerns of both sides. Section 10. The Future of Wealth and Taxes. What's next? As the debate over wealth taxes rages on, one thing is clear: the way we tax wealth is likely to change in the coming years. With rising income inequality and shrinking middle classes, governments worldwide are grappling with how to create fairer and more equitable societies. Whether wealth taxes are the answer remains to be seen. But one thing's for sure: this is a conversation that's not going away anytime soon. So stay informed, stay engaged, and let's keep talking about how to create a more just and equitable world for everyone. Section 11. Stay informed, stay engaged. And that's our show for tonight, folks. We've covered a lot of ground, delving into the intricate world of wealth taxes, corporate greed, and the balancing act between fairness and economic stability. These topics are not just headlines, they impact our daily lives in the broader economy in profound ways. We've explored the ins and outs of wealth taxes, corporate greed, and the delicate dance between fairness and economic stability. It's a complex issue with no easy answers, but hopefully you're feeling a little more informed and a lot less like you're drowning in economic jargon. If you found this deep dive into the world of wealth and taxes even remotely enlightening, or at least mildly entertaining, don't forget to like, subscribe, and share this video with your friends. Let's spread the knowledge and keep the conversation going. Remember, the more we understand these issues, the better equipped we are to engage in meaningful discussions and advocate for policies that can make a difference. Until next time, stay informed, stay engaged, and remember, it's only money. Unless you're a billionaire, then it's probably a lot more than that. But seriously, staying informed is the first step towards making informed decisions, whether it's in your personal finances or in understanding the broader economic landscape. So keep reading, keep watching, and keep questioning. The world of finance and economics is ever evolving, and there's always something new to learn. Thank you for joining us, and we'll see you in the next episode.